Australia's trillion-dollar housing sector is in the midst of the fastest growth it's experienced in decades. For many in the property industry, this is good news. However, for regulators, this is a tricky situation. ANZ economists are expecting the regulator APRA to introduce policy measures this year to slow house prices. Joining us to understand more is senior economist at ANZ Research, Felicity Emmett. Good morning and welcome.
Morning.
Now, let's start with the current situation. How sustainable is the recent growth in housing prices?
Look, when you look at what's happened over the last couple of months, you have to think this is not really sustainable. So the increase that we had in March was the highest increase since the late 1980s. Even if we look at the past 3 months, it's the highest since around 2003. So we've seen extraordinary momentum building in the housing market. We have to keep in mind that this comes after a period where prices fell a little bit. So when we look at what's happened over the past year, prices are only up less than 5%. So that's not too worrying, but it's just that there's so much momentum at the moment, and it seems, given where auction clearance rates are and housing finance is, that we're going to see more strength in coming months. And I think over time we'll find that these extraordinary increases are not sustainable in the longer term.
So we obviously hear a lot of commentary and we listen to many bits of it. But in your opinion, what are the main drivers of this growth and this momentum?
Look, there are a few things I think that we need to consider. Clearly, we've seen a much stronger and rapid economic recovery. When we look at where the economy is, by the end of December, it was only 1.1% smaller than it was pre-pandemic. So that's a very quick recovery. Unemployment is back down to 5.8%. So again, a very rapid recovery in the labour market, despite really very widespread expectations that we'd see elevated unemployment for a long time. So part of the reason we've had that really strong recovery has been the extraordinary stimulus that we've seen both from the federal and state governments and also from the Reserve Bank. So you get programs like JobKeeper and the coronavirus supplement for JobSeeker and a number of other programs from the government have clearly helped to keep incomes high, and that has helped. But when it really comes down to it, the primary driver at the moment are these extraordinarily low interest rates that we're seeing from the Reserve Bank. And the Reserve Bank has said that they're not planning to increase interest rates for another 3 years. So it's very low interest rates and the prospect of them staying low for a considerable time that's really driving them in the housing market.
And it's funny that all of this is happening in the context of, some genuine pressures that go the other way. A lot of them brought on by COVID. You've got slowing population growth and the end of JobKeeper. How are these offsetting the current buoyant environment?
Look, certainly those are headwinds. Definitely population growth is a headwind to economic growth and certainly to housing demand. And our population growth is the lowest that we've seen since World War I. So very, very low population growth. And, you mentioned the end of JobKeeper. Unemployment is still elevated. It's nowhere near as high as we thought it would be, but it's still high, too high. But I think that while those things are headwinds, they're just really very small compared to the impact of lower rates and that increased borrowing capacity that people have because of those lower rates.
So then, in your opinion, what are the main risk factors that the regulators, such as APRA, are monitoring? And I guess how serious are these risks?
Look, the regulators really don't focus too much on house prices per se. This is a little bit of a misunderstanding. It's not the RBA's or APRA's job to worry about housing affordability, really. The RBA has an inflation target and APRA has financial stability So really, from their perspective, they are thinking about things in terms of lending standards. And so if prices really grow very, very quickly, but we don't see any easing in lending standards, then the regulators should technically be happy. But that's unlikely to be the case when you see prices going up at the rate they're going and lending going up at the rate they're going. Then it's likely that what we will see over time through this strong competition is that you'll see easier lending standards. And so APRA is going to be watching for things like any increase in high LVI loans or high debt to income loans or a strong pickup in investor lending or interest only lending, those sorts of things that suggest that there might be financial stability implications down the track, what the regulators are really looking at.
What are some of the policy levers that regulators have to pull?
Look, there's a number of options for them. We've seen them address investor lending and interest-only lending. They took those measures in early 2015. They could do something like the Reserve Bank of New Zealand has done and look at high LVR loans, put a cap on high LVR loans. They could put a cap on high debt to income loans. They could change some of the capital requirements for banks, or another option is to increase the buffer that banks use on their interest rates to determine mortgage serviceability. So there's a number of options there for the regulators to look at when they get to the point where they think that really they need to do something and start to crimp down on lending.
So then I guess your best guess in terms of predicting what measures might need to be introduced at what time and what their impact would be. What's the House view at ANZ at the moment?
Look, I think by the end of the year, we will see something from the regulators. I think that given the pace of house price growth and lending growth, by the second half of the year, I think it will become apparent that something needs to be done there. It's really difficult, I think, to be certain about what measure they will take at the moment, and it will depend on what we see in the data. So far, we have seen a modest tick up in high debt to income loans and an increase in high LVR loans. Now, we don't think at the moment they're anything for the APRA or the other regulators to be too concerned about, but it's the direction. So we'll certainly be watching those sorts of indicators to see how they develop and evolve over the next year or so. So it's possible that the regulators do go for something like a cap on high debt to income loans or something like that, but I think there are so many different measures available, and it's a little bit early in the year that we really have to keep an open mind about which one of those measures that I mentioned earlier they might choose, or they could choose a combination of those measures too.
And so then, the Reserve Bank's kind of pigeonholed itself into a corner in relation to the cash rate for the next 3 years. I guess what appetite, if any, do they have to change the position that they've got in terms of holding firm on the cash rate?
Look, they have made it very clear that they need wages growth up well above 3% before they feel that inflation will be comfortably or sustainably in that 2 to 3% target band. So really, they are going to wait until we see wages growth up there. That is their main concern at the moment. They've been missing their inflation target since, I think, 2016. So this is something that they are, I think, quite determined to address. And that's why macroprudential measures are quite good, because they can limit the excessive exuberance in the housing market, limit those financial stability concerns, while at the same time interest rates can stay low so that the economy can continue to improve. We can continue to get that unemployment rate down and drive wages growth higher. And so I think that's why that combination is likely of unchanged cash rate and an introduction of macroprudential by the end